Welcome back. Let me ask you a question. Have you ever walked past a for sale sign, looked at a property, and wondered, is that actually a gold mine or is it a money pit? Most people look at the brick and mortar. They look at the nice paint job, the modern kitchen, or the landscaping. But the elite investors? They don't see bricks. They see a matrix of numbers. Today, I'm going to give you a superpower. I want to teach you how to analyze an Australian property investment in your head, literally, without a calculator, without a spreadsheet, in under 60 seconds. We're going to download a mental framework into your brain so that by the end of this episode, you can look at a price tag and a rental estimate and instantly know if that deal stacks up. We're going to cover the golden ratio of rental yield, the rule of 72 for doubling your wealth, and the secret survival line that keeps you safe from bankruptcy. This is the Napkin Test masterclass. Let's dive in. Part 1. The philosophy of why we buy. Before we start crunching numbers, we have to set the stage. Why are we doing this? Why stress over the math? In the source material we reviewed for today's deep dive, there's a fundamental truth that often gets lost in the noise of interest rates and market crashes. We invest for two reasons. First, obviously, to make money. We want the profit. But deeper than that, looking at the Australian context specifically, it's about security and independence. It's about building a wall of assets around your family so that no matter what happens to your job or the economy, you have a fortress. When you strip away the emotion, a property delivers value in only two ways. If you remember nothing else from today, remember these two pillars. 1. Income, rent. This is the cash flow. This is what keeps you alive today. 2. Growth, equity. This is the asset value increasing over time. This is what makes you wealthy tomorrow. The problem is, most people confuse the two. They buy for growth, but go broke because they ignore the income. Or they buy for income and wake up 20 years later with an asset that hasn't increased in value. Today, we are going to learn how to balance these two forces using simple mental math. Part 2. The cash flow code, rental yield. Let's start with the first pillar, cash flow. This is your survival mechanism. As the saying goes, cash flow keeps you in the game. Capital growth gets you out of the rat race. You need to know if a property is going to feed you or eat you. To figure this out, we look at rental yield. In simple terms, this is your annual rent divided by the purchase price. The landscape of yield. Right now, if you're looking at capital cities in Australia, Sydney, Melbourne, Brisbane, a standard residential house is likely sitting in the 2% to 4% yield range. If you're in Sydney, you might even be looking at the lower end, around 2%. Now, can you get higher? Yes. If you go regional, or if you get creative, like adding a granny flat, looking at dual occupancy homes, or investing in boarding houses, you can push that to 5% or even 6%. But for a standard mom and dad investment prop in a capital city, 3.5% is roughly the average par for the course. The 1,000th rule, the golden shortcut. Here is the first major hack I want you to memorize. It's called the 1,000th rule. If you want to quickly estimate if a property hits that ideal 5% yield mark, take the purchase price and divide it by 1,000. That number is the weekly rent you need to get to hit a 5% return. Let's practice. You're looking at a property for $800,000. Divide by 1,000. That's $800. If that property rents for $800 a week, you are hitting a 5% gross yield. Boom. Calculation done. But here is the reality check. In today's market, you likely won't see $800 a week on an $800,000 house in a blue-chip suburb. You might see $640. How do I know that? Because $640 is 80% of $800. That tells me instantly, without a calculator, that the yield is 4%, not 5%. See how fast that is? You walk into an open home, the agent says, "We want $1 million. You instantly think, okay, I need $1,000 per week rent for a strong 5% yield. The agent says, it rents for $700. You immediately know, that's a 3.5% yield. It's cash flow negative. Do I have the savings to support it? You've done the analysis before you've even taken off your shoes at the front door. Part 3. the survival line, break-even analysis. Now, knowing the gross yield is great, but you don't get to keep all that money. This brings us to the most critical calculation, the break-even analysis. We need to talk about the costs of holding a property. We use a concept called the 1% rule of costs. When you own a property, you have to pay the council rates, water rates, insurance, property management fees, if you use an agent, and maintenance. Over the long run, across a portfolio, these holding costs average out to about 0.5% to 1% of the property's value every single year. So, let's do the math on a perfect scenario. The equation. Imagine you found a unicorn property with a 5% rental yield. Now, subtract the 1% holding costs. You are left with a 4% net return. Now, let's look at the debt. In a typical Australian market environment, historically speaking, let's assume mortgage interest rates are around 5%. Most investors borrow 80% of the property value. We'll talk about why in a minute. So, if you borrow 80% of the money at a 5% interest rate, your cost of debt relative to the total property value is actually 4%, because 5% x 0.8 equals 4%. The magic result: you have a 4% net income. You have a 4% debt cost. 4% minus 4% equals 0. This is the holy grail of neutral gearing. The property washes its own face. It pays for itself. The reality check. However, if your rental yield is only 4%, which is more common, the math changes. 4% yield minus 1% costs equals 3% net income. But your debt cost is still 4%. 3% minus 4% equals minus 1%. You're losing 1% of the property value per year in cash flow. On a $1 million property, that means you need to reach into your own pocket and pay $10,000 a year just to keep the property. This is why I call it the survival line. If you buy 5 properties and they each cost you $10,000 a year to hold, that's $50,000 post-tax money you need to find. Can your salary support that? This mental math allows you to stress test your life before you sign a contract. You need to know, am I buying an asset that feeds me or a liability that I have to feed? Part 4. A brief detour, commercial property. A quick side note for those asking, what about shops? What about warehouses? Commercial property is a different beast. The source material highlights 2 key metrics for commercial: cap rate and cash-on-cash return. With residential, we accept lower yields because we want the property value to go up. With commercial, we're usually chasing immediate cash flow. In commercial, because banks might only lend you 70%, lower leverage, and interest rates might be higher, you focus heavily on the cash-on-cash return. If you put $300,000 cash into a deal and it pays you $30,000 net profit per year, that's a 10% cash-on-cash return. That's better than money in the bank. But remember, commercial carries higher risks. Vacancy periods can be longer, and capital growth is often slower. But for today, let's get back to the main event, residential wealth creation. Part 5, the wealth generator, equity, and leverage. We've covered cash flow. Now let's talk about how you actually get rich. This is about equity. Equity is the difference between what the property is worth and what you owe the bank. Let's illustrate the power of leverage using an example from our notes. The power of the 80-20 split. Imagine you buy a $1 million property. You put in $200,000 of your own cash, plus costs. The bank puts in $800,000. This is an 80% LVR, loan-to-value ratio. Fast forward a few years. The market goes up by 20%. The house is now worth $1.2 million. The debt is still $800,000. Your equity is now $400,000, $1.2 million value minus $800,000 debt. Here is the magic. The property value only went up 20%. But your personal wealth, your $200,000 deposit, has doubled to $400,000. That is a 100% return on investment. This is why we love real estate. It allows us to use other people's money, the banks, to amplify our returns. If you had just put that $200,000 into a savings account or bought the house with 100% cash, your returns would be significantly lower in percentage terms. This is called 5x leverage, $1 million asset divided by $200,000 cash equals 5. If you have high leverage, you get high growth. But, and this is a big, but you also have higher risk if interest rates soar. That's why keeping your LVR around 80% is considered the healthy zone. Some aggressive investors push to 90%, 10x leverage, while conservative investors or those nearing retirement might sit at 50 to 60%, 2x leverage. But for the accumulation phase, that 80% sweet spot is where the magic happens. Part 6, the rule of 72, predicting the future. So, we know leverage magnifies growth. But how fast will the property actually grow? Historically, well-selected Australian real estate grows at an average of 5% to 8% per year over a long cycle, 10 to 20 years. I'm not talking about the crazy years where prices jump 20%, and I'm not talking about the crash years. I mean the long-term average. I want to give you another mental tool, the rule of 72. This is a classic finance rule that tells you how long it takes for an investment to double in value. The formula: take the number 72 and divide it by your expected annual growth rate. The answer is the number of years it takes to double. Examples: if you buy in a high-growth area that averages 7.2% growth per year, 72 divided by 7.2 is equal to 10 years. Your $1 million property will be worth $2 million in 10 years. If you buy a high cash flow property in a slower area that grows at only 3.5% per year, 72 divided by 3.5 equals approximate 20 years. It takes twice as long to double your wealth. This is the trade-off. Often, properties with high rental yields, cash flow, have lower capital growth, and properties with high capital growth have lower yields. You need to decide, do I need money now, rent, or do I want to be rich later, growth? If you're young and have a high income, you might sacrifice yield for that 7% growth. If you are retiring, you might prefer the 3.5% growth if the rental income is huge. Part 7, manufacturing equity, active investing. We talked about waiting for the market to rise, passive growth. But what if you're impatient? What if you want to force the numbers? There are 3 ways to hack the equity equation that were highlighted in our text. 1. Buying below market value, instant equity. You make your money when you buy, not when you sell. If a house is valued at $1 million by the bank, but you negotiate a distressed sale for $950,000, you have just created $50,000 of equity out of thin air on day one. This is the hardest method, but the most lucrative. It requires knowing the true value of a property better than the seller does. 2. Adding value, the renovation strategy. This is about changing the asset to appeal to a specific tenant or buyer. The source text mentions knowing who your next buyer is. If you add a bedroom, modernize a kitchen, or build a granny flat, you aren't just relying on the market. You're forcing the value up. You spend $1 to create $2 of value. 3. The mortgage as a forced savings account. This is a psychological benefit that people overlook. If you don't buy a house, what do you do with your extra money? You buy a nicer car. You go on an extra holiday. Parkinson's law says expenses rise to meet income. But a mortgage is a forced savings plan. Every month, you must pay the bank. Part of that payment is interest, rent on money, but part of it is principal, paying down debt. Over 10, 15, or 20 years, you are systematically paying off debt and increasing your equity share. You're forcing yourself to save money every single month. Many people are wealthy not because they are disciplined savers, but because the bank forced them to be disciplined for 20 years. These are the coordinates on your map. If you found value in this napkin test, do me a favor. Next time you drive past an auction board, do the math. Divide by 1,000. Check the rent. See if it stacks up. Train your brain. Thanks for listening, and see you in next video.